Here is a strategy and a product that I cannot believe more people do not know about, even brokers. Heck, when I started as a broker, this product was never explained to me in an easy to understand way and with urgency around just how many thousands of dollars you can save by knowing the power of the Manulife One product. Okay, so the Manulife One product is the only product of its kind in the entire industry that allows you to seamlessly merge your mortgage balance, which is active every month as you pay it off, with your bank account that likely has money that's just sitting there collecting very minimal interest. And if you are an investor, a business owner, or at least you have the capacity to think like one, you're gonna love this video. So basically in this case study, you're gonna see how there's a client. They go to RBC. RBC offers them a great rate. It was a 3.9 at the time. Manulife was basically the exact same. Now, with RBC not being able to merge your bank account in to save you thousands of dollars, we'll talk about how that works. You'll see by the end of the video how you would be indifferent. You'd be indifferent to actually take a 5.9% rate with Manulife using this special mechanic, then a 3.9 with RBC not doing any amount of interesting prepayments via your bank account. So it's as if you actually went to RBC and you gladly accepted a 5.9% interest rate when really you could be saving so much more. Have I piqued your interest? Let's get started. First, let's talk about interest rate. I always say interest rate is the absolute laziest way for you to determine how much interest you pay per year to a lender. What that means is if you were to do nothing creative, no prepayments, no special financial structures, if you just set and forget, yes, a 3.9, for example, would show you in an easy way how much interest you're paying per year, okay? But that's lazy because you want to be proactive and actually use these mortgage features. So getting into things, if you actually want to pay off interest as fast as possible, let's talk about what the Manulife One does with this merged bank account. So one of our clients, they have $300,000 sitting in their bank account. You may ask, why is it in the market? It should be investing. Because this amount of capital is earmarked to be used in the short term. Therefore, for example, if they want to use $300,000 for, in this case, an investment within the next year, it'd be pretty risky to put in the stock market. It goes down to $200,000 and you got to take it out within the year because the thing you wanted to save it for is short term. So when something's short term and you cannot brace the volatility, you can't risk the volatility, it's just sitting there making maybe 1% interest. Okay, so if that's your situation, or if you're just conservative and don't really like the stock market, then in this example, you can actually use the $300,000. You can merge that with your mortgage, and what does that do? Those $300,000 are being used as a prepayment on your mortgage. So I'll give you an example, the stats on this mortgage. He had $1 million mortgage. He merges bank accounts so that now he's paying interest only on $700,000 because the $300,000 is a credit. It's lowered the balance, and then at a 3.8% rate on the $700,000. In other words, he's paying 0% interest on $300,000 at least for that year. He's saving over $11,000 per year by utilizing this credit, because the whole point is you can make 1% on your $300,000 in a savings account at 1%, right? Or you can choose to save 3.8% of interest gouging from your lender on the $300,000. So which one are you going to choose? Typically, you're going to save a lot more saving on interest gouging versus you making interest in a low interest savings account. Hope that makes sense because it's a very important detail as we go forward with more of the math. Again, a bird's eye view on this mortgage. You got $1 million mortgage, 25-year amortization, 3.8% rate, and on top of that, they are saving about $5,000 per month, net of whatever comes in from your paychecks. After you pay for all your life expenses, you've got $5,000 extra that likely is being added to those $300,000 doing nothing and collecting very minimal interest, okay? So that's the first important point for you to digest here as you get into further parts of the example. You might be wondering, wait a sec, Paul, if I prepay $300,000 into my mortgage through this credited and merged bank account with my mortgage, well, what if I have to make that investment within 3 months or 6 months? Or how do I get the money out? Because I don't want to spend $300,000 on prepayment. I'd rather spend that on the investment or save it for a rainy day. You can pull it out seamlessly. That's the thing. So for a year, you're saving over $11,000 of interest by basically paying no interest on $300,000 that you prepaid through your bank. And then you can take it out and the mortgage can reset to what it was before. But again, you used that money sitting in your bank account to save on interest. That's super, super important. And you might be wondering, well, Paul, isn't that the same thing as just prepaying or refinancing? It's not. Let's go through that. So first and foremost, if you were to use your prepayment privileges, which is generally up to 20% in the best of scenarios, you can't get it back without breaking your mortgage, having to refinance. So in this case, 20% would be $200,000. So that's less than $300,000. You're not saving as much interest. And then when you need it back, it's not that easy. It can be very complicated. It's got to be through a specific HELOC structure, which is a lot more expensive, or you have to refinance and again, break your mortgage. So that's not possible. Secondly, understand that most lenders don't even have a prepayment up to 20%. So RBC, great example. They have the industry's worst prepayment privilege, and that's 10%. So with RBC, you'd have to use up the 10%, which is once a year, which is $100,000 to prepay the mortgage, and to get that money back, it's complicated. So it's very important to understand that a prepayment privilege is not as retroactive as merging your bank account to use against lowering your mortgage temporarily or as flexibly as you want, and then you can take it out and put your money to work. Very important detail. I hope that makes sense. So in the RBC example, they might say, hey, put your $300,000 in a 1% savings account, okay? That would make you in a year $3,000. So that's the benefit they give you. So with Manulife, if you're saving, I think the number is exactly $11,400 of not paying any of the 3.8% interest on the $300,000, you're going to minus $11,400 minus the $3,000 you get as a net benefit if it stays in the savings account. You're still worse off by $8,400 by going to RBC, saving in 1% in their basic interest account, and not having the benefit of saving 3.8% on the $300,000. Hopefully you see how that math works. It's pretty simple. So really, you're worse off by $8,400 by going with RBC or an equivalent lender that you cannot seamlessly prepay the mortgage balance of, in this case, $300,000. Let's extrapolate this. So if the net benefit between an RBC and a Manulife One is $8,400 of extra cost of RBC, or net benefit with Manulife One, after 5 years, times that number, by 5, and you get $42,000 as a net benefit of going with someone like Manulife and using the special maneuver of your bank account acting as a prepayment towards your mortgage, of course, very dynamically. Now let's add another layer to this. This person is making $5,000 of net profits to their life. So the paycheck comes in every 2 weeks, pays off expenses. In this case, it'd be $2,500 bi-weekly, $5,000 a month. Those $5,000 are added to the $300,000, and it's the same cycle. So after a year, we're talking what? Around $60,000 are added to the $300,000. So now you're not paying 3.8% interest on $360,000 approximately on your mortgage. So really, you're only paying interest on the inverse of that, right? Which is going to be $640,000. So there's two layers. There's static money you parked from day one, but dynamic income money that's ideally from your payroll, or it could be from something else, that, again, as the money comes into your account, before you even know what to do with it, maybe you invest every 2 weeks, at least for those 2 weeks that the money comes in from your payroll, it's immediately credited against your mortgage and you're paying way less interest. So we've got, again, this dynamic portion from income that comes to your account every 2 weeks or more often, and this upfront amount of money that's not being put to good use. So again, all these things being layered on gives you way more benefits. So again, this is an incredible product if you're someone who can save a lot of money per month and you have a sizable amount of income you're not using. But we have a calculator. You can definitely see, what if you have $100,000 that you're not doing much with for now, and you're making $3,000 extra in your savings after expenses? You can do the math and you'll start to see that it really is something that can improve and really help you. So I'm glad you're grasping the high level of this concept. Let's keep moving on here. Let's loop back to what I said at the beginning of the video, and that is 5.9%. So now you're probably understanding that you will be still $1 better off by using Manulife One through the example we talked about, the $300,000 of savings used to be credited towards your mortgage, and the $5,000 per month in terms of net savings. You'll be indifferent to have that crediting system and still pay 5.9% on the Manulife versus RBC 3.9, but you're not doing anything special with the prepayments. So what do you think actually happened in this case? Well, obviously the Manulife rate was the exact same as RBC, even if it was slightly higher, based off this arbitrage of, again, using your bank account and your payroll. It's a no-brainer. So to conclude, it's not just about rate. It's how much interest are you being gouged per year, and how do you safeguard against that in a safe way? So you don't have to be someone with lots of savings or making lots of net profit from your payroll for this to be beneficial. Literally, you could be someone who is a baby boomer, conservative how you invest, and you just have money sitting there. Run it through the calculator and you're going to see what the net savings are. So if you're intrigued by this, you want to apply your numbers to see how much interest you can save per year by merging your bank account, your payroll payments, and your mortgage, well, we've got the special calculator. We actually made a custom one. Come talk to me. We'll run some numbers and let's start beating banks at their own game. And let's think like an investor and a business owner as we hack our mortgage, grow wealth, and get a good night's sleep. Thanks so much.